Hi, welcome to a video where we're going to talk about capitalizing versus expensing certain assets and why that's really important to know. There's no better case to get started on this than Worldcom. Worldcom was one of the largest financial reporting frauds in history, and at the time it was the largest one ever. From 1999 to 2002, senior executives at Worldcom they orchestrated a scheme to inflate their earnings in order to maintain WorldCom's stock price. It's one of these things where the stock kept on going and they didn't want it to go down, so they inflated earnings. The fraud was uncovered in June 2002 when the company's internal audit unit discovered $3.8 billion of fraudulent balance sheet entries. Fraudulent balance sheet entries. So there were entries on the balance sheet, but they were orchestrating something to inflate earnings. How does that work? So they had something on their balance sheet that caused their earnings to go up. You're going to learn what that is today. All right. So they made those, their balance sheet had $3.8 billion of fraudulent entries. Eventually, Worldcom was forced to admit that it had overstated its assets by $11 billion. At the time, it was the largest accounting fraud in American history. So let's show you exactly what they did. It's pretty easy to figure out once you kind of know journal entries. So let's assume we have some sort of asset that we're going to use, and that asset needs to be credited, right? We use up this asset and it gets credited. It's no longer in our use. Let's say toilet paper, okay? So we have toilet paper. Somehow we use the toilet paper in our factory process related, well, let's just say we have toilet paper, all right? You know what I'm getting at. We have toilet paper and the toilet paper gets used, that kind of thing. Well, we credit an asset. Once it's used, you don't reuse toilet paper, right? So it's used and it's done, right? It's over. It's not, you can't reuse it. It's gone. You don't have any future value from that. Well, there's a corresponding expense associated with using that toilet paper, right? You have an expense that you used a resource, you had it, and now it's gone. And that's what you show. You show that this asset's no longer there. You use the resource exactly how you should, and it gets expensed. It's in the toilet. It's gone. It's gone. Don't think about it. It's gone. Well, what Worldcom did is this. They said, okay, we've got these entries here. We've got debit, expense, credit, asset, right? We show an asset. But what if instead of an expense, we pretended this expense was some sort of new asset? You know, we have a debit here on the income statement, but you know, if we took an expense off the income statement, you know what would happen? We'd have a lot more income. And so this is what they did. Instead of reporting an expense on the income statement, they debited a fictional asset as if there were a value there. So it would be as if they used the toilet paper and then went to their books and said, I used the toilet paper, but it was part of a process that we still have value from. And so they put on their books that they had some sort of new asset connected with that, even though the toilet paper's in the bowl. This is fraud. This is fraud, pure and simple. And Worldcom did this, and they got a lot of people in trouble because not only they did it, subordinates did it. And so knowing whether to capitalize or expense something is the core focus of what we're going to talk about in this video. This right here, when you have an expense on the income statement, like this, right? Expense on the income statement asset, we know what that is. That's an expense. Sometimes we need to capitalize our assets. So let's say we make an investment. If we look at the swimming pool example, we've dug a hole and we pay our rebar guy for steel. Now, when we pay for that steel, we get steel and we get it put inside the pool. Well, that's not an expense. We get to capitalize that, and it'll be we get to capitalize it as a new asset instead of it being an expense. And once we capitalize that new asset, we have that asset there, and then once we collect on it or deliver the product and it's done, then it's sold. All right, then it's gone and it goes out. But we capitalize it until it goes out. If you have a car, let's say you are a factory and you manufacture cars. Well, the labor, the parts, all these things go into building your final product. You want to expense those when you sell it as a cost of goods sold and inventory leaving, and you'd capitalize it. But what happens is that you got people that get under pressure, like the executives at Worldcom, that always want to be number one when it comes to returns, and they get pressure to readjust things. And the classic thing, this happens in tech companies a lot, because classic thing is, oh, it's this tech. We're not using it. It's not toilet paper. It's something else, and they try to get it back so it's like a new asset instead of calling it what it is. an expense. And so they try to make it this entry as a capitalized asset instead of what it should be, an expense. So that's the story of Worldcom. And whenever you're, somebody's talking about a fraud, usually what we're talking about is they've either hidden their expenses as assets to inflate their earnings in public companies, or they've taken revenue and either made it some sort of fictional revenue associated with, expanding credit to people that shouldn't have it, or organizations that shouldn't have it and can't get, can't afford to pay it back, or they put some other fictional things. So it's either revenue or expenses. You either shrink expenses fraudulently or you increase revenue fraudulently. Those are two ways to do it. And that's usually what goes on when you hear these frauds announced. So let's talk about long-term assets. These are assets with long lives. Non-current assets, long-term. They're assets that are expected to provide economic benefits over a future period of time, typically greater than 1 year. May be tangible, property, plant, or equipment, or PP&E. They might be intangible, or there could even be long-term financial assets. Okay, and so here's what we do. At acquisition, when we buy an asset, there's a lot of things that go on. It's not just, you get an asset and that's all it is. At acquisition, you got to decide what you're going to do with it. You got to capitalize it, right? So what do you capitalize? The purchase price and any expenditure necessary to prepare the asset for its intended use. So anything that gets that asset prepared for its intended use. Now there's certain things that you don't capitalize, and subsequent expenditures that are not capitalized is if they don't provide expected benefits beyond 1 year and they're expensed otherwise. All right, so let's go through an example of some of these, and let's go to our classic gold rush example where we've got a shaker, rock tumbling gold sifting plant here. Okay, we have this example, and if you want to stop here so that you can go through it and read it on your own and then answer and see what you think we capitalize and what we don't, we can do that. So which of the following shaker trommel drill plant expenditures are capitalized related to the purchase of the machine? The purchase price, including taxes, of $10,900. $200 for delivery of the machine, $300 for the installation and testing of the machine, $100 to train the staff of the machine, $350 paid to a construction team to reinforce the ground to accommodate the machine's weight. Maintenance was $1,500 for improving the ground for equipment to drive for the next 5 years. $1,000 for repainting the exterior of the equipment, and repainting neither extends the life nor improves usability. Okay. So what do we capitalize? Well, when it comes to the purchase of the machine would include all of the following. It'd include the purchase price, obviously, hopefully you got that. The delivery of the machine. Remember anything we paid to get the machine to its current state. We pay for the installation and testing of the machine. You got to test the machine to make sure it works. You want to send it back to the factory if it doesn't work, all right? $100 to train the staff on the maintaining the machine. That's something we wouldn't capitalize, okay? That's not something we'd capitalize. And then $350 paid to the construction team to reinforce the ground to accommodate the machine's weight. So if the machine's staying there and it's going to have a period longer than a year that it's going to be there, and we pay a team to reinforce the ground, that's something we capitalize, all right? Maintenance. Now, some of you might say, well, the ground for equipment to drive over for the next 5 years. We probably would capitalize that and depreciate that over time, but it wouldn't be related to the purchase of the machine, all right? So if it has something for 5 years of life, we'd probably capitalize and depreciate it, but it's not related to the machine. So we wouldn't put it related to the machine, but we might capitalize that because it has a 5-year life. Repainting the exterior of the equipment, that's not something we capitalize. This is a vanity item. It doesn't do anything to improve the machine. It's just something we do because we want our machine to look red. And so that's a brief introduction to capitalizing versus expensing different assets. In the later videos, we're going to talk about intangible assets, and then we're even going to talk about zombies, and then we're going to get into depreciation calculations and different methodologies. See you in the next videos.